What does happen to the stock market during times of war? I mean, we're all a little bit familiar with modern day war with terrorist attacks and missile launches in third world countries where we tend to be the Goliath in the equation. But the whole thing with Russia and Ukraine feels very old school. We have troops and tanks and talks of an invasion. And it got me thinking, what actually happens to the stock market during old school times of war? The answer may actually surprise you, but first let's start with some fun facts. Way back when, in July of 1914, right before the First World War, the New York Stock Exchange actually shut its doors. Now, they had to because so many Europeans were liquidating their investments to raise cash for the war effort. They had to kind of cease the trading. Now, they did so for several months, and eventually they opened back up to limited bond trading, but it was almost a full 6 months before they actually opened up the door to equity trading. Now, do we expect that to happen today? No, not at all. The stock market did close, but only for 3 days after 9/11. And that's when we had a major attack literally in the market's backyard. But I digress. Back to World War I. After being closed for 6 months, the day the market opened, the equities took a huge hit of 24%. And it was a rocky couple of years. But what happened with the stock market after World War I happened again during World War II, the Korean War, the Vietnam War, and the Gulf War. She rebounded. During World War I and World War II combined, the market was up 115%. On average, the S&P 500 has about a 6.5% correction for the first 3 months following an armed conflict, either global or smaller. And then after that, around a 13% positive return 1 year later. I think most of us agree that the stock market volatility we've had this year is reflecting the uncertainty in Ukraine, but also uncertainty over inflation and rising interest rates. It did surprise me to find that during actual times of war, stock markets tend to be less volatile than at other times, particularly compared to the uncertain times immediately leading up to a war. So, what's a person to do? If you are already in the withdrawal phase, aka retirement, your portfolio should already be positioned to provide near-term cash flow in a way that is insulated and isolated from market volatility. In English, you should already have cash or cash-like equivalents set aside for your retirement paycheck, and you should not be at risk of having to take distributions or liquidations in a down market. If you are in the accumulation phase, consider buying the dip. If you have opportunistic cash on the sidelines, look for a red day to buy in. Let's say you're one of those people that fund your IRA or your Roth IRA every year around tax time. If we have a dip this March, make your 2021 contribution for last year and go ahead and make your 2022 contribution. 401k participants, keep on keeping on. If you can afford to increase your contribution, now may be a great time to do that. But whatever you do, don't stop saving, because if the market dips, you're buying on sale. As far as investments go, history shows the market as a whole has a tendency to rebound during times of war. That doesn't mean certain sectors won't be impacted. Now may not be the best time to invest in LETRX. It also may not be the time to start trading in crude oil. However, most of you are invested in a diversified portfolio, and this is particularly true for those of you who are invested through a 401k. The options available to you are indexes that are widely diversified across countries and companies and asset classes. While you will likely feel hiccups during times of war and uncertainty, it's also likely that they will rebound over the longer term. That's it for this week. This is Jeannie, the 401k lady.